I have to say the 186 of these, and I am really tired of talking about war, inflation, climate change, pestilence, and all the other problems in the world. So today we're going to try and switch the topic to talking about shareholder wealth creation, which is actually mainly the reason why we're all do what we do is to create value and wealth, and to help people in doing that. So I want to cover three things today. I want to share a report on the biggest wealth creators and destroyers back to 1926. Second, I want to discuss the Magnificent Seven and their impact not only on the S&P, but also on the MSCI World Index. And then I want to close with some thoughts on the surprising strength of the U.S. Economy. So let's jump right into it. For a while now, the concentration of the top stocks driving the market has been a big topic. And this chart shows you going back to 1974. This has been an issue going back in time. And this looks at the top 15 and top five largest firms and against the largest 1,500 companies and against the whole market. And you can see that obviously the concentration had been high back in the 70s, got lower, and now is back up again to a high level. But I think the difference, and we'll talk about this more as we go along, is the nature of the companies that are in the top and what their impact is on the overall economy, I think is a little bit different than it was back in the 70s. So what is shareholder wealth creation? It's really defined as the improvement or decline of wealth of a company's stockholders over a period of time. And with the way they calculated this report, and it's done by a professor out of the University of Arizona, of Arizona State University. And what he basically did was he looked at not just the stock price moves, but he added in buybacks, dividend payouts, divestitures, and the like. And then he said the benchmark is for wealth is what you generated above the 1 month treasury bill. And in their report, they looked at 28,000 companies, and those 28,000 companies during that time created basically $55 trillion of wealth. Ironically, 41% of those companies created 64 trillion of that 54 trillion of wealth, with 58% of the companies destroying wealth to the tune of $9 trillion. So you've seen historically a very skewed way. And wealth creation has been concentrated over time. It has actually gotten a little more concentrated recently. And I think that's due to the nature of the companies that are driving it. But I think you're going to see concentration continue. So this shows you going back to 1926, the top 10 companies in value creation or wealth creation going back in time. And the cast of characters at the top are no surprises. What was a little bit of a surprise, and this report was done on the US market, what is a surprise is really that Berkshire is still up there after all this time. Exxon's been the only one that's been in there. Exxon and Chevron were there back to 1926. Procter & Gamble came in 29. But if you notice, the rest of them all come in the 80s and 90s for the most part, other than Berkshire. So it's a very interesting dynamic there. So big wealth creation, as you can see, in the trillions for the top couple. On the wealth destroyers or value destroyers going back to that time, WorldCom at the top of the list. Interestingly, you have Rivian, who is made second in the list in a 1 year period. And as I said, these numbers go from 26 to the end of 22. And you can see the banking crisis led to some problems. Some tech wrecks along the way were part of the problems as well. This next report, next page, shows you wealth creation from, or declines, actually from 2016 to 2022 with GE, Rivian, DuPont, Coupang, and then Kraft at the top of the list there. And then looking at the pandemic period where you had Meta, Intel, Disney, Amazon, and Rivian all at the top of the list there in terms of wealth destruction, with pretty significant losses being occurring in that period. So I want to switch gears a little bit and talk about the MSCI World Index and shareholder wealth creation as it relates to that. And this is an index for the developed economies, so it does include Europe and any developed nations around the world, Japan. It is about a $55 trillion index. It has 1,500 constituents, the smallest being a little over $900 million, and the largest being Apple. So they dominate. The Magnificent Seven are getting a lot of attention. They've dominated the S&P, but also the MSCI World Index as well. And just to give you a sense, the 7 largest companies added $4 trillion in market cap, which compares to the gains to the MSCI as a whole of $3.4 trillion. So the MSCI as a whole, ex those companies, lost $600 billion last year. So you can just see the weight and the dominance that these guys have. They have a significant market cap. Their average weighted growth rate, which is really the key to what's driving them, I think is one of the keys, is 23%. Their price earnings is high and has come down, but it's still almost double what the market is. But I think the real issue that's really driving these guys is the strength of their balance sheets and the investments that they've made in the future, in the past, where they really took advantage of the zero interest rates to make the big investments for the future that they could, because they were generating massive cash flows that the other companies couldn't. So I think the real issue here is the strength of their balance sheet, the positioning that they have, and also the impact that these guys have had in changing how the world works. So US stocks have dominated the global markets, and this is just a percentage of their all company index. And you can see from a low around 2009 of 40%, it's now up to 60% of the companies dominating the world index. So when you want to get away from the S&P and go into the MSCI world, you're really not adding that much more divergence of exposures when you just look at the US company weightings being so big. And here are the top 10 companies in the MSCI world. And yes, they're all US companies. There have been several European companies in over time, but they've fallen by the wayside over the last couple of years, particularly given some of the challenges that they're facing in Europe and their leading companies. But you do see one of the largest historic gaps in terms of the valuations of the non-US companies versus the US companies. And I would just say trade carefully around this, because I think there's a lot of value traps being created. You just saw that Siemens, which is a phenomenal corporation, a great company, but has not been a great stock, announced last week that they might need subsidies from the government of around $16 billion to help with their wind projects problems. And that led to a decline of about 35% in a day in the stock. So you can see some of the challenges that are creating the values are not necessarily the things that are going to drive growth forward. So you have to really be careful about how you're investing here. We have had a significant rise in concentration. As you can see, from 2010, we're more than double the top 10 largest stocks as their concentration in the index. That did pull back a little bit with the pandemic, but then took off again with the war occurring. So we do have this setup where the big continue to get bigger, and I think that's going to be something we're going to see for some time. So switching gears to the US and the US strength, which has been surprising and continues to surprise. We just popped a 4.9% GDP for the Q3 numbers that were produced. So we have very strong GDP growth. We have full employment. The labor negotiations are yielding big returns, 25% increases or more for the auto workers, which will lead to increases coming for other companies that are non-union, just because of the competitive nature of what's going on. You're seeing inflation coming down quite a bit, and Europe just popped a nice number below 3% on their inflation. And earnings still are pretty strong, but very divergent. And you're seeing big swings in the haves and have-nots here. So I think that's something you want to continue to watch as to how divergent the things are inside the market. But we're doing this while there's still some big problems out there. You have the wars in Europe and the Middle East. You have the Washington dysfunction, which continues. And even though we have a speaker for the House finally, I'm not sure that that's going to calm things down as much as it might stir some things up again. We do have, fiscal policy has run amok, and we do have massive deficits that have to be dealt with. debt vulnerabilities are picking up, and I think you're starting to see companies that reflected in company reports is what their debt vulnerabilities are. And we have some big maturities coming in the next 3 years, and who's going to be able to absorb that, and which companies are going to be able to deal with higher debt costs at the same time they need to make big investments to be competitive, I think is something we're going to see. I think there is an adjustment to higher rates that we're still going through. And as much as we've talked about it for a while, I don't think people really came to grips with the higher rates staying up for longer until now. And when the Fed comes out of this meeting, whether they raise rates or lower rates a bit, I don't think it really matters. I think what matters is the process we're going through, that 5% really is here to stay, and that, or certainly for an extended period, and the likelihood of going back to zero interest rates is low. And therefore, we really have to wake up to how do our companies look on a valuation basis at 5% versus zero. We're still adjusting to. I mentioned this GDP was strong, and this has been a surprise. I think the U.S. continues to suck capital out of the rest of the world. And as we do that with our rate differential for the developed nations, that's going to continue to bring capital into the U.S. But one of the keys to the hidden strength of the U.S. is consumer net worth. And this is a look at household net worth going back to 2008, where we were just under $60 trillion. And look at it today, where we're back up closing in on $145 trillion of net worth in that 13-year, 15-year period. That is a massive increase in net worth that is what is really supporting this system for some time. I think what you'll hear from Powell today or tomorrow is that conditions are doing quite well. They remain surprised by the strength. That's one of the things he talked about at the Economics Club with all the tightening that's going on. And this is the proxy rate for the San Francisco Fed, which would say that we are closing in on 7% interest rates, not under 5% interest rates, when you really look at the effective rate of quantitative tightening. And I think the balance sheets for the four largest developed market central banks have come down almost $8 trillion in the last year, which is a significant tightening of conditions. If you think about mortgage rates doubling, significant tightening of conditions, bank lending standards tightening, significant tightening of conditions. And if you're trying to go and refinance corporate debt right now, you know what a significant tightening of conditions is that's going on. So I think you have two sides of the coin for the Fed. You have a very strong economy in the US, attracting a lot of capital from around the rest of the world, with consumers starting to feel the pain of the increased wage costs and the tightening conditions that are going on. But the overall strength, because the stimulus that's been put through has continued to offset some of the negative headlines, but that doesn't go on forever. And I think at some point we're going to wake up to a significant slowing of the economy, but it's not here right now because of the overstimulation that's gone on in the system. So I think there are countries that'll benefit, sectors that'll benefit, companies that are going to benefit, areas to avoid. But I want to talk about the three things that I think may surprise people coming into the end of the year. We've had a very difficult November, October. Thank God it's over. We typically have tough Octobers and Septembers. The S&P and the NASDAQ were in correction territory coming into this week. They rebounded yesterday, but still a 10% decline was expected and needed. I think if we believe that rates are peaking, which I think we're getting closer to peak rates, and if we believe that China is getting closer to bottoming, and add to it, the third factor is if the conflicts in the Middle East do remain somewhat contained, which is really the market is reacting right now, as if that's the case. I think that's a very vulnerable premise to support. But if you get these things moving this direction, I believe that the oversold conditions in the market will lead to some surprising strength coming into the end of the year. But it won't be broadly benefiting companies. I think it'll be in the areas that we're focusing on of healthcare, tech, industrials, and both sides of the renewable trade and the energy transition trade and industrial materials. So, Mark, I'm going to stop there and open it up for questions, comments, and discussion.
Thank you, Stephen. Questions? Adam, we're having a year-end awards, Adam. You're up for the first question.
And Mark, I just want to add that somebody put a note it wasn't on topic, so I think they're new. So anything is on topic for this part of the session. So,
Stephen, thank you for your presentation. My question, and this has come up before about the net worth, consumer net worth. What does that really mean? I mean, the disposable income is really what I would think is what's needed for the consumer to drive the economy. And with all the boomers retiring, and you've got trillions of dollars where they're spending and transferring, what significance is the net worth really?
Well, that actually is what's allowing them to continue to spend. And one of the changes that's going on in the economy that's really one of the bigger challenges of understanding how we come out of this is the fact that you now have these boomers with $60 trillion of net worth to spend, that they have the time to spend it because they're not working now. That's creating a new buyer that's offsetting the weakness of the low-end consumer. So it's actually an offset that's a positive offset. How long that goes on is really the issue. And it gets to the complexity of the housing market and all that, because a lot of the net worth is in the housing and in stocks. So it's added to the inequality, and it highlights some of the inequality, but it actually is what's part of what's supporting the system through this transition, which is somewhat difficult.
So just a quick follow-up. So it's the middle class and the working class that are being squeezed?
Yes, the bottom 80%.
Okay. Thank you, Stephen.
Although what is helping that too is an offset is you get these 25% wage increases coming through that do help offset that, but it's still a makeup from where they were before. But it's a lot better, and that does offset some of their pressures, but it doesn't necessarily keep them up. So they are falling behind anyway.
Yeah. Thank you.
Walter?
Stephen,
a quick question. Thank you for the presentation again today, Stephen.
You're welcome.
You mentioned in your presentation that Siemens, in its effort to go renewable with wind, is going to seek some government bailout, if you wish, from their government, from the German government. We're seeing similar things happen in the automotive industry, for example, with the EVs. Do you foresee that we may be in a situation where some of these companies are looking for government bailouts as well?
Well, ours already got them. So wait. So I think they're going to have a hard time getting another one, to be honest with you. But I think the issue for them, and we were just in one of our investment meetings talking about it, because we do like both sides of the transition, but the question is, what is going to be the car of the future and when? The EVs are declining right now, and it looks like the hybrids and the ICEs are continuing. So we're in one of those funny periods that these guys are going to have to be very nimble and flexible. And I think the strategic decisions they make now are going to be with them for a long time, and will define who wins and who loses. I think the technologies are so all over the place right now that we don't really know what the outcome's going to be when all's said and done.
Thank you.
Yeah, fascinating to see the Rivian. We knew they weren't doing well, but wow, not
well. It's funny that we've had this discussion when the meme stocks were going on, and the movie came out about dumb money or smart money, whatever they called the movie. I don't even know. But the reality is, when we're in a speculative business, that we're always looking at, what we think is going to happen in the future. And when we buy a stock, and you just don't know. And new businesses are new for a reason, and the outcomes are you often see a lot of short-time big losses, and then you have the longer-term big losses that come when you're destroying wealth. It doesn't necessarily, you don't need a long time to figure out how to destroy wealth, apparently.
Stephen, I might have missed it.
Roger, sorry.
Thanks, Mark.
Just raise your hand when you want to.
Oh, sorry.
Anna's got her hand up. Go ahead on.
Yes, Harry, just wanted to add on the EV. had an electric vehicle as a rental for a couple of weeks while my car was in the shop. And this is a perfect example of great product being developed, but the infrastructure not being in place. Just charging the car, it takes so much time just to find the charger. If you're on the road, it's just totally impossible. You can do it through an app, and it's so unproductive. So I think it's a perfect example when the companies would take like a minimal viable product out there, but the infrastructure is not supported, and the market perception now is so much down because of that. So the adoption is now going downward, and for it to pick up again, it's going to take so much more improvement and so much more investments. So thank you for bringing that up, Walter.
Well, it's interesting. I think it was Toyota is working on a solid state battery that may get charging in 10 minutes for EVs, in which case you'd have the counter to what the frustration you just described, Anna, being resolved, and that could really see a pickup in that. But right now you are seeing it go the other way. The initial enthusiasm and the level of patience that we have in the US is being offset by that. So I think that's really the hard part about making investments in this area, is you're going to have to be pretty nimble.
Maxwell, just 2 seconds. Roger, did you want to make a point?
Well, just a quick question. Thanks, Stephen. I might have missed it. That was a little late going on. Do you have a chart that kind of shows the Magnificent Seven, their performance over time vis-a-vis the rest of the market X the seven? Did you have that slide, or did I miss it?
No, I don't have that performance slide right now. But I do know
you did the weighting,
if you looked at the S&P versus the S&P Value Index, the S&P Value Index would be around 8% lower, I think, was where it was this morning, somewhere around there. So it's a significant discount to the rest of the market in terms of its performance. I think I mentioned the 7 overall, Roger, added to the MSCI World Index $4 trillion, and the overall index is up 3.4 trillion.
Yeah, the reason I asked you, I remember in COVID, I think when the summer of 20, when obviously the market went in a direction I didn't think it was going to go, went up. I remember I saw the statistic that said that the FANG stocks, which were effectively the 7 you're referring to, they accounted for, 95% of the companies on the S&P were actually down, even though the market was on fire. And that had to do to the fact that the FANG or the Magnificent Seven were putting the market up. So even though everybody thought the market was going up, but 95% of the companies by number were actually lower than they were March of 2000, which is a phenomenal statistic.
Yeah, we are going the other way. I think the divergences are going to continue to grow between the rich and the poor.
Yeah.
Michael, before you and Andrew go, Maxwell had his physical hand up.
Hey, just a simple, maybe I'm just naive and don't fully understand. When a stock loses money, that's a liquidity event. So does money, from the presentation, it sounds like money just disappears. But when people are making money, obviously people are losing money. And when people lose money, somebody's making money. How does that work? So $9 trillion in losses, but isn't that somebody else's gain?
Yeah,
whether it's a company they spent too much money with or some other category.
Let me step back. They started with, yes, it is a zero. Somebody bought what somebody sold, so there is somebody on the other side of every ticket. What they did here was they took the starting point when the company came into business and figured out the total value when you add it back in dividends and buybacks and divestitures and the like that don't always get tracked in the stock price. So they actually did a more comprehensive view of that, but it's really each company was their value grow or decline over time based on the invested dollars. And I think that's what they were looking at. So
gotcha.
I think that's really the right way to think about it.
Terrific. Thank you.
By the way, Maxwell, what are you doing for lunch on Thursday?
No plans at the moment. Happy to join anything you're up to.
Come join us. We're at Stephen's offices, 44th and 5th.
Oh, excellent. I live right here.
12 to 1:30. Anna, you're going to come in?
Yes, I am joining. Thank you.
And Joe, where
Looking
are you?
forward
I
to
have
it.
no idea where you are, Joe Azzaro. Are you within striking distance?
I am. I'm in Brooklyn. Yeah.
Okay.
So possibly on Thursday, I'll see you guys. Let me see what's going on.
Okay. All right. Michael Hammer.
So, Stephen, very interesting and provocative presentation. But I was thinking about Apple because they were listed as like number one.
Yep.
And when you look at time frames, depending on the time frame that you look at and pick, so for example, Apple was a destroyer of value when Jobs was forced out until he came back. Right. So I think timeframes and timing are very important for this sort of discussion.
Yeah, absolutely. And that's why it was interesting to look at the 16 to 22 and the 19 to 22. So you could actually see what happened pre-COVID and post-COVID, even to just get that window. But you're 100% right. I mean, the time you pick to go into a stock, particularly one like Apple, matters greatly. And I just know from when we went in at ARS, we went into Apple in 2011 after they came out with the iPad is when we went in because we thought that was a game changer. And I can't tell you how many times we talked about selling that stock from that point forward.
Mm-hmm.
And actually the argument back then was it was a $110 billion stock, which is really tough to grow 10, 15, 20%, those size companies. And then you fast forward in there, 2.6 closing on $3 trillion. And you get a sense of how different the world is and how different the businesses are. But that's from 11 to now. They've had that kind of growth. So it's really phenomenal. And then you look at Meta, which has had massive value destruction in that period where you would have thought, given the tech was working so well, it would have been a good time for them to do. So you're 100% right, Michael. You really have to look inside it to see what's going on. But it's also a reminder that wealth accumulation does take time, doesn't happen overnight, but you can destroy wealth pretty quick.
Andrew Voss.
Thanks, Stephen and Mark. Stephen, of the 60 trillion in net worth, was that the figure?
It was 60 trillion back in 08. It's 145 now or so.
So of that 145, what's the percentage breakout of taxable versus non-taxable assets? Do you have
that?
You don't have figures like that?
No.
If you were to guess?
What was the guess? I would say that taxable is because you're having housing in that. So if you just think about the equity portion is probably a third to 45% of it. I would kind of think of it that way. I would think it would be half of that or something like that. So maybe a third of to a half of, probably about a third, maybe that a little less, quarter to a third.
Roth IRAs and the like.
Yeah.
Yeah.
401ks or, defined benefit plans would be in there as well. So
Sure. Okay. That was just a quick question. Thank you.
Bill would probably know better because he's a trustee of a pension plan.
And Bill, we need to talk. Let's find some time next day or so.
Yeah, that'd be great. That'd be great. Yes, to the question on how much taxable versus non-taxable. It's an interesting question. Because the average 401k balance is actually pretty low, across the whole spectrum. So across the whole, income demographics. So I would say that real estate is probably the lion's share, of that accumulated value in real estate. But then it's going to change, when you look at the various income brackets, it's going to change a lot. Because obviously the top, 10%, 5%, 1%, their mix is going to be entirely different so it's going to be driven a lot by those, top earners. So anyway, but it's interesting to ponder. The other interesting thing, kind of going back, one conversation back is, fun fact, Amazon has had drawdowns of up to 94%. And I think, over time, seeing drawdowns of 35% is not unusual within a 12-month period of time. So it's a real, even those numbers are eye-popping, but the road to it is just laced with potholes of substantial size. So it poses an interesting question, and in it for the long haul, it takes on entirely new meaning. But so here's my question. So Stephen, with PCE, having come in, both headline and core now down in and around the 3.5% range, kind of to your point on, with all the other tightening going on, I would think that the Fed has good reason to pause for a while now. So,
yep. I saw a survey today that I think the market is thinking that the market's moving, instead of, it was 4 cuts before the last meeting. They moved it to 2 cuts at the last meeting. I think they may be moving it to 1 cut starting in Q3 of next year. It would be before you see the first cut. I don't think the Fed needs to do anything right now in terms of raising rates. And I think they'd be making a mistake if they tried to lower them right now. I think they need to, I don't think they know. I think Powell's been pretty clear that they don't know, and people think he's playing games, but he's saying that it could go either way. This economy is much stronger than he thought, but the problems are big, and that you could break very quickly with the wars percolating around the world. So I think he's going to play it cautiously and not do anything. I think you're right. I don't think he needs to do anything right now.
Right. No, I would agree that the tightening that we don't see on the surface is a huge hammer. And
yeah,
we don't want that one to come down on us. That would be pretty awful.
And when you go in, I was out looking at cars for my kids, and you try and go to get a car right now and go through the process of credit and all that. And, for the kids, it's really tough. So I think it is 2 very different economies. It's the one for everyone who has money and the one who doesn't for the people who don't. And I think we're starting to see that going to become even a bigger issue as we move forward.
Jack Wyant, I see you on camera. How are you seeing the Heartland, and how are the Cincinnati teams doing, particularly the football team? You're on mute. You're going to owe us all a drink here in a second.
Yes, so the Heartland is healthier than the 2 coasts. So come out and visit so you can see it and feel it and hear it. As to the teams, their records speak for themselves. Both of our so-called football teams scored big victories on Sunday, but that's 2 days ago, so it's in the past. We've got our soccer team has to play. We've Harrison.
We've talked about coming to Cincinnati because all the games are going to be at home now, right?
Well, no, we're playing in Harrison, New Jersey this Saturday, and then the following Sunday.
Saturday.
Out here, Saturday the 11th.
Yeah.
Out here. Yeah.
On the 11th. Okay.
Yeah,
Jack,
I did.
When's the big vote for you guys?
Beg pardon?
When's the vote in Ohio?
The vote?
Yeah.
They're 2 biggies. One pertains to abortion.
Yep.
And the other is something else big. I'll have to stop and think. There's a Cincinnati issue that's a biggie in this exact part of the world where we're going to sell for $1.6 billion, sell a railroad line that the city owns to a railroad. And the debate is, can we trust the government, the city government, to properly manage the $1.6 billion of cash they're going to get. But
I saw our mayor, your mayor, was promoting that.
yeah.
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 Andy Fish has a question, unless you had one, Jack.
Oh, it was back on the much more boring topic. Stephen was talking about two economies and the car loans. Actually, car loan delinquencies are spiking like mad.
Yep.
New housing mortgage applications are near zero. And I was just talking to somebody down south who said that housing prices are starting to really crater, which I haven't seen anywhere yet. And there's a housing shortage and so on and so forth. So I think it's very much two economies and even two worlds. I put up a chart where I keep getting things about the Japanese market and Japanese stocks, but the yen is hitting new lows. So if you price those stocks in US dollars, they're not doing very well. So there's all these different ways of looking at the same thing. And back to Stephen's comment, Stephen, I don't know if you have anything to add to that, but.
No, it's actually, it is interesting. You know, they also raised their benchmark rate up to 1% now on their 10-year, up from 50 basis points, which was 25 before that, and then 10 basis points before that. It's hard when the dollar is, when the U.S. has, you know, almost 5% interest rates and the strength of our economy, to see how you're not going to attract a lot of capital from the rest of the world. And I think that's going to put more strains on other currencies as well. It's also pushing governments to start, particularly adversary governments to the U.S., to increase their gold holdings and to start buying more gold again. And I think that's one of the things that's pushing gold up a little bit now too, is the push away from the dollar for adversarial countries back.
Jack, you want to say something?
Stephen, in regard to the car loan point,
Yep.
How could that be if new car sales are hitting this year the 17 million level, which in the automobile industry is happy days are here again?